Right, well, I think we will start. So, ladies and gentlemen, welcome to the latest Melplash Show webinar. It's been some time since we've had one because we haven't thought of a topic or a topic hasn't arisen which we thought we could build our webinar series around. But on the 30th of October, something happened which you're obviously well aware of. And as a result, the society thought that it's something we should really try and tackle. We're not here, obviously, to make any political comment as to the fairness or otherwise of what has been proposed by the new government. Instead, what we'd like to look at is what it actually means. There's been a great deal of talk, obviously, in the press and other media as to what it actually means to the farming community. Um, and it's therefore terribly important that we get the true story and getting the true story from experts. And obviously, experts, all sorts of people are called experts. But I can honestly say that our two guests this evening are proper and real experts in this field. Firstly, Sam Kirkham from Albert Goodman, Chartered Accountants. She's based in Taunton. She is nationally recognised as being an expert in this field. And she's on, for example, the CLA National Tax Committee. She's already done 5 presentations today alone on this subject. And she has been on Channel 5 News commenting on the whole issue. Iwan Williams is from Michelmores Solicitors. They're a national firm of solicitors. Iwan is based in Cheltenham, and he is a legal tax expert, and he has had a number of articles published on this subject in, for example, the FT Advisor and the Independent. So I can honestly say we are delighted to have, and we're really honoured to have experts. We're going to do this slightly differently to the webinars that we've held before, which have been perhaps on a little bit more informal basis. Sam and Ewan are going to give a little presentation on where we are from their perspectives. Sam is going to go first, and then after she's given her little presentation with slides, I will then ask various questions, and hopefully those questions are based upon the ones that you asked me to ask on your behalf. To ask a question, please use the chat line facility at the bottom of your screen. I will then pick up those questions and ask accordingly. I've also been asked to say that the whole thing is being recorded, and if you therefore want to watch it back again and pick up points that you perhaps missed first time round, it will be on the Society website fairly shortly. So, less of me and more of our experts. Sam, I think we're over to you.
Thanks, Nigel, and good evening, everybody. As Nigel said, I'm Sam Kirkham. I'm head of the Farms and Estates team at Albert Goodman Accountants. I'm an accountant and a chartered tax advisor. And as Nigel said, I also sit on the CLA National Tax Committee. So as you can imagine, since 30th of October, it's been pretty busy, both working and talking to our clients about these proposed measures, but also we met last week, the CLA Tax Committee, just to agree what we should or shouldn't be lobbying on. So there's a lot of work going on in the background. And the CLA are very joined up with the NFU and the TFA, so that there's a joined up lobbying between the three of them. So in my session, I'm going to concentrate on inheritance tax, but just briefly run through some of the other measures that were announced in the budget that would impact farming businesses. So can I have the next slide, please? Could I have the next slide, please? Thank you. So first of all, if we talk about capital gains tax, so there was a lot of anticipation that the capital gains tax rates were going to go up potentially to income tax rates, so as high as 40 or 45%. Actually, whilst they did go up, they haven't gone up as high as some anticipated. But basically, CGT on residential property has stayed the same, remaining at 18 or 24%, depending on whether you're a basic rate or higher rate taxpayer. But it was the commercial property CGT rate, so gains on land that went up from budget day to 20 or 24% for higher rate taxpayers. So that took effect immediately. And for those that entered into contracts to sell land before budget day that complete after budget day, there are what we call anti-forestalling rules to try and catch them in the new rules. So even though they try to bank the rates that applied before budget day by exchanging contracts, they might be caught by the new rules under these anti-forestalling rules. So it'd be important to take advice on that. The other, the relief that we often use, particularly for landowners, for capital gains tax is business asset disposal relief. So that's bad R that's on the slide there. That allows people to sell land or on a disposal of a business and pay CGT at a much lower rate of 10%. Again, that was anticipated that it might go altogether, and it will go eventually. But effectively, we've got the 10% rate now until 5th of April. And at 5th of April, it's going to rise to 14%. And then the following year, 18%, which is the lower tax rate for residential property. So it's being brought fairly in line. So again, if you're selling assets and you're intending to claim business asset disposal relief, then doing that before 5th of April 2025 should be considered. One of the really big costs that was announced in the budget was the increase to the employers' national insurance rates. So going up by 1.2% from 13.8% to 15%. So a big cost to employing people. And in addition to that, the secondary threshold, so the point at which you start paying employers' national insurance, was reduced, so from 9,100 to 5,000. So the employer's national insurance costs will kick in much earlier. To try and counter some of that, they they took away the threshold for eligibility for the employment allowance, which does mean that for those that employ less than 4 people, they may not be too heavily impacted by the employer's national insurance changes, but those with more than 4 people will be. So it's worth considering what the cash flow impact of those changes will be on your business for next year. Moving on to stamp duty. So the SDLT rates we've had for a few years now, an additional rate of 3% where you're buying second homes or additional property. So if you already own property and you buy another property, residential property that is, then you have to pay an additional 3 percentage points on the normal rates of SDLT. From budget day, that 3% increased to 5%. So the cost of buying residential property where you already own a residential property has become really very expensive. And that also applies to company purchases. Alongside that, the national minimum wage as well increases from April next year. So the national living wage increases from £11.44 per hour to £12.21. Which is an increase of 6.7%. And those between the ages of 18 to 20, that rise goes from £8.60 to £10. Apprentice rates have also gone up from will go up from £6.40 to £7.55. So there's been a lot in the press about employers and the cost to businesses of employing people and the impact that will have on certain businesses. And it's very true. It is going to be a big impact on a lot of businesses that employ staff. Moving on to the agricultural budget. as Nigel said, I've been speaking at the CLA Transitions in Agriculture roadshow for the last 2 days, and there was a lot of talk about the DEFRA budget and how the press are trying to tell everybody that they've given so much to farming with an increase to the DEFRA budget of £5 billion. That is actually over 2 years. It's not a budget for 1 year. It's a 2.7% increase, far less than what people were asking for to make up for inflation. So yes, there is an increase, but it really didn't go far enough, certainly when we start thinking about the other impacts of the budget that we're talking about as well. At the same time, could I have the next slide, please? Double cab pickups. This wasn't announced in the budget, but was in the papers that were released after the budget, buried deep within those papers. If you remember, earlier in the year, the Conservative Party just announced, not in a budget again, just randomly, that double cab pickups would be treated as cars from next year. They did a very quick U-turn on that, but then the Labour Party have now said that they're going to treat double cab pickups as cars from April 2025. What does that mean? Well, it means that at the moment where you have a double cab pickup, you can reclaim VAT, you can claim 100% capital allowances, so you can relieve the cost of the pickup against your profits 100% in the year of purchase. And if you're providing pickups to employees to use for private use as well, the benefit in kind is only £3,000 a year. With effect from April 2025, if they're cars, you don't get any of that. However, there is a window of opportunity because it won't apply to pickups you have now. It will only apply to pickups that you buy after April 2025. So if you're looking to change your pickup, then you might want to think about doing that before 5th of April 2025, because that pickup will not be bitten by these new rules after 2025 until the earlier of April 29, when the vehicle is sold or when the lease, if you have a lease on it, comes to an end. So it's worth considering if you are looking to purchase a pickup, the planning for that. Next slide, please. The other hidden that came after budget day actually announcement was the escalation in the decline in the de-linked payments following BPS. So they've escalated the amount that those de-linked payments would reduce by. So the 2025 claims will be based on 24% of the 2020 claim, but with a maximum claim of £7,200, which for some large claims will be a massive drop in their BPS payments that they would have received previously, and obviously with no notice whatsoever, really. And so considering the cash flow impact on the business next year, so we normally see that coming by December next year, we need to be considering what cash flow impact that has on businesses next year. Next slide, please. So really today we're concentrating on inheritance tax, and that was the biggest shock in the budget, and the one that there's a lot of worry about, and the one that's where we're concentrating the lobbying on. As you are all probably aware, historically we've been able to pass the family business on in lifetime or on death, feeling fairly comfortable that there would be no inheritance tax to pay because of a combination of agricultural property relief and business property relief. Agricultural property relief is available at up to 100% on the agricultural value of agricultural property. 50% relief applies where it's a landlord that owns the land and there's a lease in place that is a pre-1995 tenancy. Business property relief has also been important for farming businesses because we use that relief for claiming the relief on the value of the working capital in the business, such as the value of the herd, the stock, the crops in the ground, all the plant and machinery, etc. But also, historically, we've tried to bring what otherwise would be chargeable, unrelievable property, such as let property, into a business to claim 100% business property relief on that let property because it's within a business that is mainly trading. And a mainly trading business, an interest in a business that is mainly trading, qualifies for 100% business property relief. The 50% rate of relief applies if you own the assets outside of the business. So it's not, the property isn't in the business. You're not leaving an interest in a business, but you're leaving an interest in a business and some property that's used by that business. That is when the 50% rate of relief kicks in, which is why we always try to plan to have the property in the business, so 100% relief. And just to note that that 50% relief, if the business is being run in a limited company, then the owner of the assets needs to control that company to get the 50% relief. And if they don't control it, there is no business property relief. Next slide, please. So rolling on to 30th of October, and we had the budget and the real shock announcement that there was going to be some radical changes to the relief for agricultural and business property. The measures announced were that from April 2026, the 100% relief for the combination of both agricultural and business property relief would be restricted to value of up to £1 million. Any value left worth more than £1 million would then only be relieved at 50% relief, which is an effective tax rate of 20%, i.e. 50% of 40%. And at the same time, they also announced the scope of agricultural property relief would be extended to land managed under certain environmental agreements. Now, that's something that had been lobbied for a couple of years. We finally have got that now and draft legislation, but this will be caught by these new measures from April 2026. So environmental land, IHT on environmental land comes in April 2025, but from April 2026, it will be also caught by these new measures. So if the £1 million allowance is already being used, that would be 50% relief on any value in excess of that. The £1 million allowance is available per individual, and that allowance is not transferable. And I'm sure Iwan will be talking more about this in a minute, but we need to make sure that the million, where you've got a husband and wife that own property, and let's say the husband dies first, leaves everything to his wife, because he hasn't utilised that £1 million allowances on his death, it's not available because it's not transferable to the wife on her death. So there would just be one £1 million allowance. So goodwill planning is going to be needed going forward if that doesn't change. We've always had the position that inheritance tax can be paid in instalments. We've never had to worry too much with agricultural land because often there isn't too much of an inheritance tax liability because of these reliefs. But going forward, because of the restrictions to reliefs, we need to consider how that inheritance tax can be paid if it isn't avoided. Inheritance tax on land, assuming the land isn't sold, can be paid in annual instalments over 10 years. In addition to that, whilst usually interest is charged on the outstanding balance, which will go up to 8.75% if the base rate doesn't change between now and then, where it's agricultural property or an interest in a business, then the revenue won't charge interest on the outstanding payments so long as each instalment has been paid on time. The question is whether the inheritance tax is affordable to be paid over 10 years, which we'll have a look at on the next slide. But before we move on to that slide, just to also mention, that's not on this slide, in the budget, they also announced pensions will become inheritance taxable from April 2027. So those with undrawn pension pots or balances in their pension pots that are left on death, that historically we've been able to pass to the next generation without an inheritance tax bill, if they're left after April 2027, then the value of those pension pots will become chargeable to inheritance tax. But again, we haven't got any detail on that as it stands. Next slide, please. So the question I just asked is whether the inheritance tax would be affordable over the 10 years so that no interest would be paid. And to try and put these rules, new measures into context, on this slide, what I've done is compare 4 scenarios. And we've heard a lot of talk in the press about Labour saying that small farms would not be impacted by these rules, and lots of questions as to whether that's a £2 million farm or a £3 million farm, and what size farm would be impacted. Now, these 4 scenarios are based on various assumptions, so might not be typical of everybody, and everybody's case is very different. But these 4 scenarios assume that we've got a husband and wife owning the property jointly, and they've got goodwill planning to utilise both £1 million allowances. So there's £2 million that can get 100% relief. It also assumes that the value of the assets at the top there, the 100% relievable APR, BPR assets, which would include the land, the buildings, potentially the farmhouse, and all of the working capital, so the herd, the crops in the ground, etc., that is all they own, that they don't own any other property that might be chargeable to inheritance tax. So in that case, they would have their tax-free nil rate bands available. So everybody can leave up to £325,000 free of inheritance tax on death. So for a married couple, 650,000. And where the estates are worth less than £2 million, then there's the potential to claim the residence nil rate band, where you're leaving the main home to your direct descendants. So if we go through these scenarios and just look at the £4 million scenario first, you'll see that there's 2 £1 million allowances deducted, and then we've got 50% relief on the remaining £2 million, so £1 million of relief, leaving 1 million chargeable. And on the basis that they have goodwill planning and they have no other assets, the nil rate band and the residence nil rate bands, which total £1 million, would fully relieve the rest of those assets. So potentially, based on those scenarios, husband and wife, 2 £1 million allowances and no other assets, you might say a small farm is £4 million worth of property in that scenario. But as I said, every case would be different. But in that case, there would be no inheritance tax payable. If we look at the 6 million, 10 million and 20 million scenarios, then there is no residential nil rate band because of the value of their estates. And therefore, not just because of that, but because we've got a lot less relief and more value, there is then an inheritance tax liability. So for a £6 million value of property, there's an inheritance tax liability of £540,000 or £54,000 a year over 10 years. For 10 millions, a 1.34 million liability payable over 10 years, 134,000 a year. And then a £20 million holding, a 3.34 million liability payable over 10 years, that's 334,000 a year. So the question then is, can the business afford to pay that inheritance tax liability over the 10 years out of its profits? So what I've then done is looked at what the profits might be on that farm using the Farm Business Survey for 2022-23 and looking at that survey, what the average return on capital was. In 2023, that was a peak year for dairy, where their returns were 4%, but typically when you average the dairy over 4 years, it's around 2% and sometimes lower than that. And livestock minus 0.5%. So rather than taking the 0.5% 2023 figure, I've actually gone for 1% return on capital. So that generates profits of 40,000, 60,000, 100,000 or 200,000, depending on the value of the business. And of course, from those profits, you've got to pay income tax. And so that next line then confirms the net of income tax profit that business would have each year between the husband and wife. Now, profits are needed not just to pay income tax, but they're needed to fund existing debt repayment, existing hire purchase repayments. The profits are needed to invest in the business, so new machinery, capital costs, regulations, and also for the family to live off. But if we look at these scenarios are saying, well, if all of the net of income tax profits were used to fund the IHT bill, how long would it take to pay that in IHT bill? And clearly, it shows that profits based on these assumptions are insufficient to fund the inheritance tax liability over 10 years. Therefore, we need to think about what planning can be done to reduce that inheritance tax liability, or otherwise face a business either choosing to sell assets or having to take out debt from a bank, which would of course be chargeable, which would have interest charged on it, but would allow them to spread that cost over a much longer period, but would clearly impact on the ability to borrow from the business, to borrow within the business to invest in the future. So what should people be thinking about doing going forward? Next slide, please. So first of all, the top message there is try not to panic. Obviously, the phones have been very busy. We've had lots of conversations with people about this who are clearly very worried about it, and rightly so. We've got 18 months to consider what should be done about it. During that time, we hope to get a technical consultation in the spring, where we'll A, know a bit more about the detail, but B, have a chance to feed back our thoughts on it. And obviously there's lots of lobbying going on as well, to either try and reverse these measures, which may be a bit difficult, but also potentially to offer other solutions and maybe soften some of the impacts. In the meantime, it's important that people take advice. Consider what the actual impact is on their own business of these two measures, what their IHT position would look like under these proposed measures, because they're not going to fit into those scenarios. Everybody is different, and it's important people understand what the input looks like, and then to consider what options are available to mitigate or deal with that potential IHT. And there are options, which Iwan's going to take us through in a minute. But also just to highlight, I think one of the positives that we could see going forwards coming out of this is the need to discuss succession and potentially handing assets on down to the family, the next generation, but discussing the succession plan with the family much earlier on in the overall succession plan than we might have done in the past. And it's important to start bringing the family into the discussions now and considering what that succession plan looks like and whether anything can be implemented earlier. but to not panic and make rash decisions purely based on these inheritance tax measures, because whatever you do needs to be fit for the purpose, for the future viability of the farm, for the family in the future. Thank you, and I'll hand over to Ewan.
Thank you, Sam. Sam, that's really, really helpful. That's really set the scene in a fantastic way. I was going to suggest, or I did suggest earlier, that we're going to ask some questions, but I'm acutely aware of the time. We do only have an hour, and we've spent half of it already, possibly due to me chatting. So what I'm going to do instead is to go straight on to Ewan, and then we can deal with some questions at the end. Ewan.
Brilliant. Thank you, Nigel, and thank you very much, Sam. Good evening, everyone. My name's Iwan Williams. I'm a partner at Michelmores. I deal with all aspects of tax and succession planning, most often for rural businesses, landed estates, and business owners generally. I'm going to continue the conversation on the proposed changes to inheritance tax, and in particular, the changes to agricultural property relief and business property relief. There's no getting away from the fact that these are profound changes. There was a lot of nervousness pre-budget about capital gains tax, nervousness about changes to agricultural property relief. Of course, there was, but I think we might have hoped or even expected that the government would consult properly on these sorts of extremely important issues, given the depth of feeling and the unintended consequences that changes in this area, this complex area, can have. So in the absence of that, it was a shock. And as Sam says, we're in a position now where the question for us as advisors and as a rural community, I suppose, is where do we go from here? How do we plot a course through this changing tax landscape? Next slide, please, Lucy. Thank you. Thank you. So the first slide here, I've titled the positives question mark. I've listed here some things that were unchanged by the budget. We had profound changes to APR and BPR, but these are the things that remained. The gifting regime, potentially exempt transfers. Sam has already touched on the likelihood that some onward gifting and generational transfers might be accelerated. But there was concern about that 7-year rule for gifting and whether that might be abolished or restricted or indeed extended from 7 years to, say, 10 years. That didn't happen. The IHT spouse exemption, no IHT payable between spouses, that remains. There was nervousness about that. Other valuable reliefs, heritage relief, I've mentioned there, that might apply in a landed estate context, for example. Woodlands relief, CGT uplift on death. The CGT increases weren't as bad as we expected, and the valuable CGT reliefs remain as well. You'll be familiar with rollover relief in a rural business context, holdover relief in a rural business context. These remain, and combined, these are still powerful estate planning tools that can be used in the right circumstances and for the right business to affect a successful succession plan. So, as Sam says, it's important not to panic, to consider these things in the round, and to remember that in the right circumstances, options remain. Next slide, please, Lucy. Thank you. So when we're looking about planning for the future, we're saying not to panic, but there are fundamentals that can be considered whilst we await the further detail and ultimately the legislation that will govern these changes, the legislation not being due to land until sometime next year. So what can we be doing in the meantime? Number one there, existing wills. It's very important that existing wills are reviewed. Sam mentioned the £1 million allowance, which is not transferable between spouses, as far as we know. So the old adage of I leave everything to each other, or everything to each other on the first death, is not going to cut the mustard when it comes to relievable property under these new rules. So it's very, very important that existing rules are reviewed. Existing wills are reviewed, I should say. I saw a client yesterday, and I asked them whether their wills were up to date, and they said, we don't have wills. So it's especially important in this new changing landscape for that to be a trigger for review. Partnerships often dovetail with wills. We often draft wills and partnerships agreements so that they sort of speak to each other and dovetail to ensure succession of partnership interests on death. That's another trigger for review, making sure that the wills dovetail appropriately with the wider business arrangements. And in all likelihood, in these times of uncertainty, we would be perhaps recommending a more flexible, sophisticated will structure to make sure that all available reliefs are appropriately captured. The key point is having the correct legal structure within your will to be able to react, so that your executive trustees can react to the circumstances that might exist at the time. Being a very boring lawyer, I'm going to say that lasting powers of attorney are always important, both in a personal and in a business context, to ensure the continuity of the business in circumstances where perhaps the donor has lost capacity or is losing capacity. They are always important in what are always almost very difficult circumstances. And we mustn't forget the absolute fundamentals here, particularly in a rural business context where there might not necessarily be a full understanding of the documents that hold the business together. So the partnership agreement, is there an up-to-date partnership agreement? What other agreements and documents govern the ongoing nature of the business? What about leases and tenancies? In these times of uncertainty and change, pulling those strands together and making sure that you have your ducks in a row, you know exactly where you stand, having that flexibility and agility to react to the changes that will be sort of written down next year in the legislation is going to be extremely important when it comes to succession and perhaps tax efficiency as well. Next slide, please. Thank you. So Sam mentioned accelerated gifting, or gifting to the next generation, as a powerful estate planning tool. And we're likely, we think, to see a change of dynamic in a rural business context. Perhaps in days gone by, there was the sort of the safety net, the reassurance of dying with your relievable assets, your agricultural assets, and claiming 100% agricultural property relief. That dynamic is perhaps going to have to change, and the next generation are going to have to be engaged at an earlier point. Now, tax is an important driver, but it shouldn't be the only driver to that sort of decision making. It's a very important part of rural business succession, but there are all sorts of other things to consider. And these are issues that can be considered now whilst we await the detail and the further legislation. Onward gifting to the next generation is not an easy conversation to have. It's often in the too difficult pile, as we all know. Are the next generation engaged? Do they want to inherit the business? What are their views on its future direction? Do they get on? Does one sibling farm? Does one sibling not farm? How is the business going to look? Where do you want to end up effectively? These are really important succession-based conversations that should be had. sooner rather than later, so that everybody knows where they stand, and that the business stands a better chance of ending up where everybody wants it to. But gifting to the next generation, it does come with risk. You're losing control over those assets. You have to give them away with no strings attached. So you can't retain a benefit in assets given away. I mentioned there affordability. It's very important that when you give assets away, you don't retain a benefit in those assets. And the question is, can one afford to give those assets away? They need to be careful not to be overly generous and ensure that they retain, sufficient provision and income for their retirement and their retirement plans. So that's a very, very careful balance, and a potential risk, because if you get that wrong and you do retain a benefit, then it renders the IHT planning aspect ineffective. So, as Sam says, take very careful advice when considering how to structure those transfers. Another one of the bullet points there: prenup and postnup arrangements. If you're gifting assets down a generation, you're potentially opening those assets up to, potential matrimonial issues or financial issues in the hands of the next generation. Now, in a rural business context, often the idea is to keep those assets together for the owners to be custodians for their lifetime, and then pass down the generation. They pass the business as one. So prenup and postnup arrangements are an effective estate planning tool to protect against those potential risks. If we were having this conversation 10 years ago, then prenups would have been far newer, I suppose, and less tested. We're expecting them to be more and more popular. Popular is probably the wrong word, because it's always a delicate subject when it comes to prenups, but certainly worth considering to try and protect against those matrimonial risks. I've mentioned generally, when we're talking about succession and engaging the next generation, this element of fairness as well, and protecting against future disputes, making sure that everybody's on the same page, essentially. Having those conversations sooner rather than later are probably more likely to avoid potential disputes further down the line. And again, having a full and understandable suite of documentation governing the rural business means that things are more likely to move smoothly from a succession point of view. Accelerated gifting. Sam mentioned the anti-forestalling rules, that there might be this window of opportunity now to give assets away before the 6th of April 2026, but pending further legislation. But there is this risk if the anti-forestalling rules come in, and we do wonder whether life assurance, if affordable, will play an increasingly important role in protecting against potential inheritance tax liabilities, both post 6th of April 2026, when these new rules will kick in. Next slide, please. Just on the topic of business succession planning, and we've covered a lot of this in the previous slide, but we do see what we call family business constitutions or family business charters as an effective way of trying to document a rural businesses or a rural family's agreement on these key succession points. So a family business constitution, it's not necessarily binding. It's just a blueprint a blueprint of the future direction of the business from a succession point of view. How can the next generation be engaged? What's the future direction of the business? Who's going to be involved? What's the culture? What's the ethos? Where does everybody want to end up? What happens on a divorce? What happens on a marriage? What happens on a death? These are all things that should be considered and then potentially embodied in this sort of agreement. They can be jolly helpful in trying to plot a course through what is always a difficult set of conversations. Next slide, please. Thank you. I just wanted to touch on trusts. Very, very briefly. There are two main IHT regimes that apply to the taxation of trusts. The beneficiary regime, where assets are aggregated with the beneficiary's estate on death and subject to inheritance tax, or the relevant property regime, where assets are held in trust and they're subject to a maximum IHT charge of up to 6% every 10 years, or when assets leave the trust. Now, we've talked about the £1 million allowance. We've been told by the government guidance that trusts created before the 30th of October 2024 appear to have their own £1 million allowance. That could be important. Trusts settled or created after the 30th of October 2024, which share a settlor, will also share that £1 million allowance. The key point to make here in relation to trusts is that we're awaiting the detail. There is this technical consultation due to take place in early 2025, which will hopefully provide us with some additional guidance as to the best way forward and how to plan, potentially using existing trusts, and what to do. I think, and Sam, it'd be interesting to know your view here as well. My view is that existing trusts that were settled before the 30th of October 2024, until we have the guidance, I wouldn't be winding any of them up. Not in full anyway. I think it's a case of wait and see. And there's also a question about whether we might see the creation of a number of new trusts between now and the 6th of April 2026 to receive assets which currently qualify for 100% APR or BPR. That might just be a window of opportunity for some effective tax planning in the right circumstances. And I won't go into that sort of detail, but it is something that's very much on our radar, and should be on the wider radar when businesses are discussing these sorts of succession and tax issues. There's an argument to say that trusts might become less effective, or new trusts might become less attractive post April 2026 if, due to the changes to APR and BPR, there is this 10% entry charge. I think that's going to result in less people wanting to transfer property into trust. Next slide, please. Thank you. I'm conscious of time, so I'm going to whiz through. But valuation issues. I've talked about this change of dynamic, and rural businesses, we're faced with this changing landscape, and we as advisors and as a community are going to have to think slightly differently and more creatively, potentially, about how to plot a course through these changes. And might valuation or attempts to deflate values be a way of securing that? Sam's talked about the £1 million allowance that applies per individual. So might there be a case for dividing ownership to secure as many £1 million reliefs as possible? Joint ownership discounts can also be valuable when it comes to deflating values values, and we do just wonder whether values might be suppressed in other ways via, for example, reversion releases or tenancy arrangements, something that was far more common, I think, in the 90s, wasn't it, with that sort of planning as part of a longer term succession plan. Um, it- what about the value of agricultural land? Full stop. Is that likely to be affected by the IHT changes in light of the restrictions to the relief? Most of the people that I've spoken to over the last month or so feel that it might result in taking the additional froth out of the market, but um, I don't think anybody is expecting the value of agricultural land to drop off too significantly. Next slide, please. And just very briefly on how to structure these potential transfers or accelerated gifting or attempts to segregate ownership. In a rural business context, we'll all be familiar with partnerships. We see them, continuing to play an extremely important role in sort of holding assets and protecting assets and controlling assets through that partnership structure. But interestingly, we are seeing sort of increasing interest in corporate structures. I mentioned family investment companies there as a potential structure for generational estate planning. The idea would be for a corporate structure to be set up, and there's any sort of future growth in value of the assets held by the company would effectively accrue to the next generation. It would be a much longer term inheritance tax planning vehicle, but the beauty with this sort of structure is that the person giving the assets can retain some sort of control, either through acting as a director or through retaining certain classes of share. I don't want to go into detail, but just wanted to flag these sort of slightly more interesting creative points that we may now see on a more regular basis in this context due to the changes that we're seeing. Next slide, please. Thank you. So just to sum up a few of these potential planning points, what do we do from here? Don't panic. Have those succession conversations whilst we wait for the legislation to drop over the coming months. Just for any families where there has been a death within the last 2 years, and the deceased may have owned assets that qualified for agricultural property relief or business property relief, post-death planning in those circumstances could still be important if you're within 2 years of death. So take advice on that. Are things being structured as efficiently as possible given these changes that will be coming down the line? I've touched on the possibility of new trusts to effectively bank 100% APR or BPR in certain circumstances prior to the 6th of April 2026. Is there this window of opportunity for that sort of planning? I mentioned perhaps not winding up any pre 30th of October 2024 trusts until we have that further detail in case they could be valuable. But the key point, I think, at this point is that those succession planning conversations, those discussions, getting your ducks in a row with regard to the documentation, making sure that you have the most appropriate legal structures in place, will then mean that the business has the agility, the flexibility to react to those changes and be as efficient as possible yeah, whilst we once the legislation has arrived and um, be in the best position possible to capture that tax efficiency, if possible. Next slide, please. And I think it's back to Sam for the summary, isn't it?
Probably just conscious of time, Nigel. I
Thank you.
don't think this summary adds anything to what we've already talked about. So I don't know whether you want to go straight to questions, Nigel. You're on mute, Nigel.
Nigel, I think you're on mute. We can't hear you. Sorry.
Sorry,
Yeah, so that's it.
That's better. Sorry, I was just saying that we're running out of time. We do have some questions that have come in, so I'll quickly rush through one or two very small ones. You touched on it, but just to clarify a point, because it's come in twice now, Ewan, the question is, can I receive an income from the farm if I gift it away? And you clearly said that's not the case.
Well, Sam will have a view on this as well, but well, Sam, perhaps you want to take that one.
Basically, you shouldn't continue to receive the same income that you might have done in the past. So if you're giving assets away and you're still in partnership, you can still be in partnership, but your partnership share should reflect your input into the partnership. So if you don't own any land going forward, then your partnership share should reflect the time that the management that you put in. If you do have some land, it'll be a combination of both. Likewise, if you come out of the partnership, you could continue to be employed by the business, but the salary that you have should be commensurate to the work you do. So it would be a salary that you would pay someone else to do the same job. So it's important that there's evidence to show that the income that continues to be received is commensurate to the work that they're doing. Which might mean a drop in income if they're giving land away.
And again, a question that's been asked twice. What assets should I be thinking of gifting sooner rather than later?
Yeah.
Sam, you, either?
Yeah. It's two groups of assets really. Firstly, I think holiday lets, where people have got holiday lets, and I know there's a lot in Dorset. There's a window of opportunity. When you give assets away, it's a chargeable capital gains tax transfer as well as being an IHT transfer. And normally we can rely on capital gains tax holdover relief so that no tax is paid and the gain is deferred until the person that receives the asset sells the asset. Holdover relief is only available for certain assets, agriculture property, trading assets, not let property, but at the minute, holiday lets qualify for holdover relief. But we also know that the holiday let tax regime is being abolished from 5th of April 2025. So gifts after that point of holiday let property won't qualify for holdover relief. So if people are looking at their inheritance tax and succession planning and have holiday lets, those might be properties that you want to consider gifting before 5th of April if you're considering gifting them anyway. And again, so long as you can afford to give up the income that you're receiving from them. Other assets will be assets that are increasing in value. So if there's barns that are going to get planning for conversion or agricultural land that might become housing one day and sold for development, or agricultural land that's got an option to lease that will no longer be agricultural land, thinking about passing those assets on, again, if you can afford not to have them or receive the income from them, because you can claim holdover relief on those whilst they're agricultural property. You won't be able to once they're not agricultural property. And also if you gift them, it's the value at the date of gift that would come back into charge if you didn't survive the 7 years, as opposed to the value that might have increased later on. So holiday lets and assets increasing in value would be the main ones you might want to think about gifting sooner rather than later.
Okay. Well, we have run out of time. It's amazing how quickly these things always pass. So, on behalf of the society, can I thank Sam, Ewan, greatly for your input. What is clear is that obviously you've just said don't panic. But having said that, the critical issue is everybody is different, and therefore you really need, as individuals, to take proper advice. And needless to say, Sam and Ewan would be happy to give that to you. So as a plug for your two businesses. The other thing that I've taken away quite carefully from this is perhaps the other piece of advice that Sam and Ewan are going to give you is don't die within the next several years. That would be quite helpful as well. So on that cheery note, um, can I thank the members for joining us again, and hopefully we will have another webinar on some other subject in the near future. So thank you very much indeed.
Thank you.
Thank you.